Good evening, everybody. Uneducated Economist. So I'm going to talk a little bit about Fed monetary policy, and then I'm going to leave it alone for a little while, the topic anyway. This one's coming out of Seeking Alpha, dated February 10th, and it just kills me when I see articles like this. It says, the Fed is watching the stock market, and that could mean trouble. And the first paragraph goes something like this. The Federal Reserve Federal Open Market Committee left interest rates unchanged at its meeting last month. However, the committee statement released after the meeting effectively canceled the series of future interest rate increases the FOMC had previously planned for 2019. The question is, why did the FOMC see the need for this policy change? Recent declines in inflation may explain part of the shift, but the likelier reason is the performance in the stock market, which is cause for concern. So if you're not familiar with the Fed's monetary policy up until just recently, is they had dropped, during the financial crisis, they had dropped interest rates down to zero, and this was hopefully going to stimulate the economy with a flood of new credit. Well, about 2 years ago, they started raising interest rates, and they were going to do it very slowly. They started at 0.25% every quarter, right? And they've gotten them up to about 2.5%. And they just recently put a pause to the interest rate hikes. Now, the Federal Reserve is mandated, okay? They're mandated to do two things. They're mandated to stabilize prices and keep it around this 2%, inflation, this expectation that they're looking for, and keep low unemployment, okay? So the Federal Reserve, during a recession, would try and drop interest rates, right? This would stimulate the economy with the new credit. Once this new credit got its way into the system and found its way to the labor market would start to swell. This would bring down unemployment. Once they got to full, employment, like the labor market they saw was running at full capacity, they would raise interest rates up until they met that employment, that full employment, right? Where they were no longer restrictive nor accommodative to the economy. And they would ride that, and they would attempt to ride that until the next recession, okay? And then the whole thing would start over again. Now I want to read this to you. It says, information received since the Federal Open Market Committee met in December indicates that the labor market has continued to strengthen and that the economic activity has been rising at a solid rate. Job gains have been strong, on average in recent months, and an unemployment rate has remained low. Household spending has continued to grow strongly. While growth of business fixed investments has moderated from its rapid pace earlier last year on a 12-month basis, but overall inflation and inflation for items other than food and energy remain near the 2%. Although the market-based measures of inflation compensation have moved lower in recent months, survey-based measures of longer-term inflation expectations are little changed. Consistent with its statutory mandate, what we talked about, the committee seeks to foster maximum employment and price stability. In support of these goals, the committee decided to maintain the target range for the federal fund rate at 2.25% to 2.5%. The committee continues to view sustained expansion of the economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcomes. In light of the global economic financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate to support these outcomes. In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to the maximum employment objective and its systematic 2% inflation objective. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressure and inflation expectations, and readings on financial and international developments. So when I read this, the very first part of this whole thing, right at the very beginning, indicates that job labor markets has continued to strengthen and that economic activity has been rising at a solid rate. Job gains have been strong on average in recent months, and unemployment rates has remained low. So they said in here, we got stable 2% inflation other than food and energy, which is what most people spend their money on. but they say they have somewhat stable inflation. They're saying that the job markets are killer, right? They're doing great. So their mandate is going well, right? They raised interest rates up, hopefully to get to that neutral, right? But as long as these markets are doing well, they should either continue or maintain interest rates where they are. The moment that we see things change, where they come out and say, hey, we've got really bad job markets here, or hey, we got bad economic indicators here. There are those things that are coming up, right? We see them. We got a lot of economists talking about their recession coming up in a year, right? But as far as being data dependent, the Federal Reserve, as far as I can tell, sees good growth, good employment, stable inflation. There's no reason why they would drop interest rates. Okay? So I'm going to leave it here for now. You guys let me know down in the comments there what you guys think. Now, obviously, if we start getting some data out there that starts being negative, like especially when it comes to the job market, I think that's going to be the ticket. If we start seeing the jobs market churning, you're going to see the Federal Reserve drop interest rates right away. Okay, but as long as we keep having 300,000 new jobs, keep getting added, there's no way they're going to be dropping these interest rates. They're trying to raise them. Okay, they're raising them. Why? So they have ammo for the next recession. All right. I'm going to leave it there, guys. Uneducated Economist. Talk to you later.